I think, and a lot of other people think, and our guests think, the biggest stock market crash is on us now.
Greater the bubble, greater the burst. That's my number one statement from everything I've studied in demographics and cycles. The greater the bubble, the greater the burst.
Well, the problem, I don't know, and historically, I've never seen so much money printed in such a short time.
That is the worst thing I've ever seen in history. I am going to go down, Robert, saying these central bankers are the stupidest people in all of history. For the stocks to be going to new highs in the greatest depression, downturn with the COVID-19 in history. Okay, wake up. This is an alarm. Get the hell out of the stock market. For the NASDAQ, the leading stock bubble, to get up above 11,000. That's what I mean. That was my target for the bubble to peak. And it has done that. It has done that more than that. At the same time, I'm looking for this Stan Harley, who is the best short-term forecaster in markets, says the same thing.
I think Harry makes some good points about the market. I'm a market technician. I look at a variety of fundamental, quantitative, and technical factors. Primary technical analysis with an emphasis on market cycles. But I've looked at several things, and I'll highlight a few of them here. First of all, unemployment. Unemployment reached about 3.4%, which is very low historically in the post-World War II era. That occurred in February of this year. So historically, if we had 5 to 7 months to that February level, that would suggest about now for a stock market peak, plus or minus.
And now is August 2020.
August 2020. Then I look at other things. I look at market cycles. I look at divergences among the various indices. The market has a propensity to make significant troughs about every 7 years, Robert. The last one occurred in February of 2016. 7 years prior to that, March of 09. 7 years prior to that, October of 02, and so on. Going forward in time, the analysis points to December 2022. Of course, before you make a low, you have to make a high. And the highs in that cycle tend to occur between 2 and 3 years prior to the low. So back of the envelope math, if we're going to make a low in December 2022, back it up 2 to 3 years, let's use 2.5 as an easy average. That points to right now.
But there's a bigger cycle, which Stan and I both agree on. This is rare for a short-term guy like Stan and me to be looking at a 90-year cycle. If you look at the stock market, since the stock exchanges were established in the late 1700s, back 250 years, okay? The greatest cycle evident in the stock market is every 90 years you get a super bubble peak, like 1837, then the crash into 1842, and then 1929 to 32, and now. This is the biggest cycle we will see in our lifetimes. I've been saying this for decades.
You have been. You've been having warning. You've warned a lot of people about the 90-year cycle. So yeah. That's today. From the Great Depression. Dan, quick, what do you think on that?
I agree with Harry. I think we are making a 1929 style top, an 1835 top, 1720, all of those three that preceded this one. I think this is on the scale of that one.
This is totally artificial. This whole boom since 2009 has seen the lowest growth in GDP in any recovery ever, and the greatest increase in stocks and financial assets ever. Something's wrong here. It's called printing money to offset a downturn.
And I believe this is an artificial economy right now. It's not consumer driven. It's being driven with borrowed government money. And it's going to work until interest rates rise. My work says interest rates are going to remain low for about another 2 years. Once they turn the corner, then that's going to make the situation extremely problematic. The U.S. government is going to have a hard time servicing the debt, which means we'll have to slash spending. When the government slashes spending, that means fewer jobs, and it snowballs.
What advice would you have for mom and pop with a 401k, IRA, or somebody counting on their government pension in the stock market?
Listen to people like Harry and others on your show. Keep abreast of all the information out there. and at the end of the day, make your best decision. In terms of being careful with the information you're hearing today, I would suggest that investors use some type of trailing stop, whether they put it in with their financial advisor or they put it in themselves or they just keep it mentally, but essentially set a floor. So if the market does roll over, then get out and go to cash.
A stop means if it's at $10, it goes to 8, you're out.
You're out, yes.
Stop is at 8.
If we do go into a decline, I don't think it's going to be a modest decline. I think it's going to be a significant decline. And at least by taking themselves out, they're going to avoid that.
I would say the same thing. Things have gone in one direction, all financial assets up, but there has been one financial asset, the 30-year, 10 and 30-year Treasury bonds that went up, even in this crash in February to March. That's the safe haven. Everybody says it's gold. No, it's gold long-term, but not short-term. The Treasury bonds and the US dollar is the safe haven for the world. It went up. And so even if you say, oh, maybe Stan and Harry are wrong here and stocks can keep going up, well, Treasury bonds have kept going up in value in this bubble. It's the one safe haven, and you've got to get out of stocks and you've got to get out of expensive, I call it expensive real estate. Real estate is also in a bubble because of record low mortgage rates.
Man, something's coming. And the question is, what are you going to do?